and welcome to the sixth module, Use Cases in Financial Services of this course, Blockchain for Finance Professionals. This module covers cross-border payments, smart assets in trade finance, share trading, smart contracts, online identity, and we'll learn this in 12 different sessions.
Let's go into more deep dive on the financial use cases. So there are some interesting use cases, case studies, which I will just like to highlight in this section. So you see, these are the use cases. Actually, these are the financial industry matrix, that is retail, commercial banking, investment banking, markets, infrastructure, asset management, and insurance. I'll touch on each one of them in some extent. So basically, what you have is blockchain potential applications that is kind of disrupting. If you see that's in the future of transactions. So you, whether it is digital currency or smart contracts or securities or record keeping, you have most of the things like changing. So in terms of digital currency, you have remittances, you have microfinance, you have P2P lending and global payments. And similarly, you have the equity, private markets, debt, derivatives, and all on security side, and you have something called wagers and escrow on the smart contract side. This you already know about it. So the compelling use cases are like smart contracts, which we have seen, smart assets, basically which comes in trade finance, supply chain, workflow rich data. Clearing and settlement, we have seen some of the use cases. Payment, this is I gave an example of Ripple, where the framework is shifting from ACH or Swift. And digital identity, where I have seen like KYC kind of stuff. So these are some compelling blockchain use cases that financial industry is using. So there are stack of processes and there are financial instruments where best suited for blockchain. It can be clearing networks, international transfers, clearing and settlement, asset ownership, auditing, reconciliation, reporting. Whereas in terms of financial instruments, it can be private equity, bonds, derivative commodities, trading, spending, mortgage, microfinance, and servicing. So these are some of the best use cases that can for blockchain. So trading, clearing, and settlement functions will be automated using a blockchain, using smart contracts and oracles. So this is how it happens. In the market, you can be on the chain, off the chain, and there's simple smart contract that comes as a security contract, and oracles is like off chain, because if you're not on chain, you can still or do the integration with the smart contracts, and it can work with the existing systems and network participants, and they do not interact with oracles directly, because the most important thing is in the interaction in the chain itself. So oracles as like offline chain, basically integrating with the smart contracts. So these are the fintech landscape, some of the great companies that's coming through blockchain. You can see like Coinsetter, PS Nova, Mirror, and BitGo. So these, and bitcoins, you have something like Alpha Point, Bitpoint. So these are some of the fintechs that's kind of disruptive forces in the financial services. And we have seen this, a lot of companies from Fedor Bank to UBS to Santander to Society General, all are kind of understanding this disruption. They are doing some POCs, some of them are live. For example, I don't want to touch the entire thing, but just for self reading. So you have a lot of things like Society General has started with cryptocurrency expertise. BNB Paribas is using faster transaction with blockchain. If you take on the ING, they are taking for Rabobank with Ripple. So there's so many things that's going on. And we have seen like venture capitals also. There are a lot of active investors. Where they are kind of getting is like the transaction verification services, that's a top. Then you have payment processor, financial services, infrastructure, exchange, not to leave anything like so mostly this is a little old slide, but then the thing is like last year we have crossed like more than private equity for venture capital in blockchain. So why there is an investment interest in blockchain? Because blockchain has the potential to reduce infrastructure cost by at least 20 billion in a financial services. I'm talking of a large scale industry. P2P money transfer across international borders, it's already worth 500 billion, and there's at least like 1 billion investment that has gone in, and the 4,000 active fintech startups in the New York area, and it's kind of tripling in next 1 or 2 years.
That's all for this session. Next, we will discuss about advanced financial use cases in blockchain. Thank you. Hello, we will get an idea about advanced financial use cases in blockchain in this particular session.
So what are the financial services use cases for blockchain? Let's understand a bit of it. Blockchain for banking. So first one is letter of credit. As you know, like in the export import, there is execution using letter of credit. It's a kind of a credit facility that is extended to the buyers or sellers. So you can do the letter of credit with the blockchain, and it increases the speed of execution from 4 days to 1 day. Then there is something called corporate debt. Basically, what happens is you can actually do a market capture of invoices based on the the inventory and kind of real time. So this is one of the big use cases. Repurchase agreements, because uh, there should be a frank, transparent marketplace for bids and asks. So there is a lot of counterfeiting happens here. So that means like you can use repurchase agreements using smart contracts. And supply chain and B2B contract, that's where like where the buyer and seller happens for purchase of goods, or services, or whatever it is, right? So supply chain. So these are some of the financial use cases for blockchain, especially in for banking. You have security services, you have capital markets, you have trade finance, and you also have card operations. Security services, like that's basically on the trading side. So you have settlement, post trade operations, and trade repository. So we have seen this. Post trade is like basically it reduces from 3 days to one, almost like real time. Capital markets, like you can have a derivative trading, or you have a derivative post trade management, or syndicate loan. And you have trade finance. We have dealt a lot in this trade finance, basically connecting between parties. And last thing is card operation, where I said like even in India there is a KYC process for almost like 40-45 banks or conglomeration. So these are for banking and banking consortia. So basically what you see is like the financial services has been increasing from 2015-16. This is just a selective ground that financial services is changing the landscape in the next couple of years. So this is one example. Securities trading between the depot and the nostro. Basically, there is a lot of time that is required and money goes into reconciling. But if you use blockchain ledger, this all comes under one ledger, and you can save cost, you can save time. So reconciliation is a very manual effort, right? And it's basically doing one cycle to another cycle, one the approval from another person to one second position, be it cash positions or security positions. And so if you just have a one ledger, right, so it's easy to transact you from entity level to no end level. So be it trading rail or security settlement or payments rail, it just happens with the banks. And now if you see global payments, see the understanding, right? You have one, two, three, that is first process. Second process, that is transfer money. You initiate relationship, you transfer money, that you have two subsections. Then you have 3, 4, 5, that is beneficiary. Then you add KYC, then you have 5, and then you have 6 people. So what is happening is a lot of state pain points. You have inefficient onboarding, you have vulnerable KYC, you have cost and delay. It's error prone because many of the manual processes, it doesn't show the liquidity, and it's also demanding regulatory compliance. This is the current state process, but just future state process, it's like seamless. Basically the process remains the same in terms of beneficiaries, but what happens is like you have a seamless process. You have cost savings, you have um sender and beneficiary, receiver, basically all under one ledger. It's real time anti money laundering or KYC, and it's reduced settlement time. It gives you cost savings, and it's automated compliance. So from verification of KVC till the distributor, all runs on distributor ledger. So it's a very foolproof process, and I guess like blockchain will actually it started transforming the way, at least in payments use case. And there are a lot of companies which have started using for their trade finance and other use cases using payments. So very good example of global payments you have seen from current state to future state. And insurance and PNC claiming, you have a manual process, some mammoth process, like you have 1, 2, 3, 4, 5, 6, 7, 8 steps. That means from a time report loss, from an insuree that gets into the reinsurance, to loss adjustments, to claim agents, to claim approval, initiate payment. So it's a quite a long process. You have broker, you have insuring broker relationship. Some of the pain points are its undesirable customer experience. fragmented data sources, fraud, a lot of fraud happens. You never know, like, what is the right process, costly intermediaries, and manual claim processing. Future state, it's a 7-stage process, but then, like, it's all it's going to stay in the same ledger. So you have claims processing, claims assessment or loss assessment, and claim approval all in the same page. And how it is going to benefit: simplified automated claim submission, enhanced customer experience, and automated claim processing, and reduction in fraudulent claims, integrated data source, and streamlined payment processes. So the payment can be almost like real time, right? They can initiate a smart contract for payment, and the insurer can get the money in the bank. Then you have syndicated loans. Again, you have loan request. Step 1, step 2, step 3. You go to step 4, member. Then it goes step 5. The main thing is, like, it's a time intensive process, lack of technology, labor intensive, lack of integration, inefficient fund dispersal, default risks, costly intermediaries, siloed systems. So if ultimately, if you require a loan syndication from many banks, there's a lot of siloed systems, right? Uh, so this entire thing will be pledged using this one. So it just runs on the same three processes: syndication, diligence and underwriting, and closing and servicing. So it's all in the same level, right? So you though the process may be same, but it runs on a huge foolproof, like, smart contracts. It helps you in, servicing documents online. You have a embedded syndicate formation, you have automated diligence, you have technology integration, you have servicing intermediation, and reduced counterparty risk. Stage is seamless, right? So this is cumbersome, but here it's like everything is through smart contracts. You have the whole network lying on each other, so it's a very optimal process, right? And it saves a lot of money and time. Similarly, trade finance, you see the current process, like, from the time order goods, so he has to create a LOC, he has to do the documentation, it goes through an shipment, it goes to the inspection company, then the importer bank, and finally it initiates an import bank. So many things. So what happens is, like, invoice factoring, manual AML review, there's a lot of duplicated bills of lading, delayed payment, multiple platforms, multiple versions of truth. We never know what is right, what is wrong. So the entire thing can be just transformed. All that you have to do is just initiate a goods transfer and provide invoice, goes through a smart contract to an import bank, go to the customs. You have all through similar smart contracts. Just hits the import bank, it just approves it, and then it comes back. So this completely reviewed into real time. Transparent factoring, disintermediation, reduce counterparty risks, decentralized, proof of ownership, whatnot, automated and settlement, reduce fees, and regulatory transparency. So we have a case study that's like Barclays. They have done live trade finance with real customers. They're very happy. Then Montego, they have used trade finance. They have also used anti-money laundering, know your customers, and capital markets. So Montego is actually IRDBT working group on blockchain technologies. Very good one. Monetego, basically that's like very good one. Oxysys is a money transfer platform between cities, and this has been taken by a lot of governments as well, and it's been tested in Asia and attracted more than 10,000 users. Alpha Bank, they have kind of used this technology first in Russia and through smart contracts on basis of blockchain technologies, and basically helped. The main objective was to check on the reliability capability of smart coin operation. Basically, S7 Airlines and Alpha Bank for service payments. Interbank blockchain. So basically, these are some of the companies. Yes, ICICI, yes, and Axis. They are Indian ones. They are also doing a pilot in this entire case study. Bosch, they have done using for trade finance, know your customer, capital markets. So how it is done is, like, Bosch, Cisco, BNMyoli, and others launched new blockchain consortium. So they have also set up a derivatives exchange. Yes Bank, it's basically using Hyperledger. They have used vendor financing and seamless integration with client ERP and bank systems. So it's reduced the cycle time from 4 days to real. Immutable transaction history, transaction status seamlessly and transmitted. Superior crypto key, and paper transaction itself is done out. So they have done for financing Bajaj Electricals in India. Regulatory chain, this is like between Deloitte, Northern Trust, State Street. So the entire thing is like collaboration, proof of concept. And direct chain is an investment funds. So basically they are doing it for capturing transactions, managing reporting with smart contracts, and enhance compliance. So what happens is it's basically a collaboration between multiple stakeholders examining the use of blockchain to manage and monitor regulatory reporting. And they found it very satisfactory. So you have plethora of use cases, right? You have P2P, you have currency, you have gaming, trading, data. So there's plethora of financial use cases. And you have typical banking applications, Santander. There are also something called customer behavior analytics and custody services. So all these are some of the banking application that's kind of going gung-ho about it. And SETL used permission blockchain to select customers for cash and asset settlement. That's a bit good example. And Santander is using it for cross-border transactions. It's like a payment service provider. It's a new PayPal through banks. So distributed ledgers will support smart contracts, and they will enforce with the contracts. And they have a wide variety of potential use cases. It can be trade finance, swaps, derivatives, or counterparty risk. So wherever it is, it's very lower rate, and it reduces fraud, counterparty risks, and whatnot. And it's going to sit on the same ledger. So SCTL is a permission ledger system that helps top tier banks, as example. It's simple, unified, and immediate. So what is the thing is basically move cash and assets immediately and achieve settlement transaction finally very fast. So that's what we have seen some of the great use cases in financial services in this section 1.
Here is the end of the session. In the next session, we will know about use case payments. Welcome to this session. Let's talk about use case payments in this session.
So we will touch upon deep dive of use cases. We will give this the goals are like a broad set of assumptions will be developed, and you have introduction, you have current state, you have future state, what are the barriers, and how do you conclude. So this entire format I have used. Actually you can do this as a self reading as well, but I will try to summarize the key points in this entire module, because this is like a standardized format which can just give you a lot of answers. It's a time tested one which I've created using basically with great experience on this. So our focus will be on what is assumptions, what are the considerations, how technology, regulatory compliance, and stakeholders alignment will be done. So end to end that with set of assumptions. But the minimal thing is you should, why we are using high potential, because it's used for shared repository, it has multiple writers, it has minimal trust, it has intermediaries and transaction dependency. These are the challenges for any of the financial services. We have seen this earlier. So on that, you have multi-parties, you have shared repositories, you have transaction between so many entities, interdependency between transactions, and so on and so forth. So we have seen this global payments. They are doing real-time settlement, and they are ensuring a KYC process, bringing a legality, cryptographic hash, and they are addressing standards and interoperability. Insurance, we have seen mainly in the P&C claims processing. Basically, they are facilitating for the property and casualty, and to potentially reduce the fraudulent claims. And implementation conditions, comprehensive set of asset profiles, adopting standards, and providing a legal framework. So these are some of the ones they are using in P&C claims. Syndicate loans, summary is basically they are using DLT to automate syndicate information underwriting, disbursement of funds, and reduce loan issue times. The implications are that forming syndicates through high speed regulator view for facilitating AML and KYC. AML is anti-money laundering and KYC is know your customer. They are underwriting risk because they reduce the number of resources, and smart contracts are actually real time. So what critical condition you need to understand is it's a risk rate framework for syndicate selection, and they are standardizing the diligence and underwriting templates, and they are providing access to financial details. See, basically you need to understand where they are using, what are the critical conditions, that means if you want to use, and then how do you actually formalize the process. So I'm just giving that. This is mainly important for deposits and lending, because this is the core of the bank. Similarly, on the right hand side you see trade finance. So again, they are trade finance, they are trying to create a new system, reduce counterparty risks and faster settlements. Critical conditions for implementation is they need to provide transparency into trade finance agreements, enabling interoperability with legacy platforms, and rewriting global regulatory guidance and legal frameworks. And financial instrument, what is the implication? Co-creation, improved facility of credit management through smart contracts, real-time transaction visibility, and eliminate of corresponding banks. completely out. You can directly do from an export bank to import bank. Capital raising, there's something called CoCo Bonds. They are using smart contracts to reduce the stress, and their implications is like it's a tokenized bond instrument and data driven decisions. Smart contracts is being used. I'm sorry, because smart contracts is the one of the biggest use cases in blockchain, and they're giving provider transparency into loan. What are the critical conditions? Standardizing attributes, standardizing trigger calculations, and developing process to act on real-time notification. So CoCo bonds, contingent convertible bonds, these are very important ones, and they are using blockchain to a great extent. Basically on the capital raising, investment management. Again, they are using DLT to store financial informations, get out with manual audit activities, reduce reporting cost, and deep dive regulatory oversight. Why critical condition means, like for implementation, they are providing compartmentalized access to data, automated, faster and efficient for enforcement of regulations, and enabling interoperability. And implications for financial institutions, again, seamless interaction, smart contract facilitation, and storing financial information. Similarly, proxy voting, this can be for shareholder meetings. They are doing via smart contracts. They're trying to validate the votes and basically personalize analysis, and the critical code is like storing investment records and integrating legacy voting mechanisms into tokens and collaborating across actors. So again, what is the implications? Like reduce time, simple ledger, proxy statements getting out, and smart contracts can actually automate the entire voting process, end-to-end confirmation. So again, use case in investment management. So we have seen this actually going into at least a high level of what is a summary. How are you doing implications for, what's the implication for financial institutions? FI stands for financial institutions, and what are the critical conditions for implementation? So let's understand a bit of global payments in detail now. So global payment, current state is a payment refers to transferring a value from one to, for example, for exchange of goods or services, and it's a concept where basically multi-geography and multiple fiat currencies. And who are the key stakeholders? You have money, sender, beneficiary, transfer, center bank, beneficiary bank, SWIFT, loan clearing. So the entire transfers are always known as remittances. And key market participants, these are some of the roles which you can just read through. Be it money core, correspondent bank is supporting, SWIFT is supporting, local clear network is supporting, and regulator is supporting. But just see how this is going to transform. And this is the current state process depiction. They initiate a response, they go transfer money, they deliver funds and act upon. So current state is like, they perform AML, KYC activities, collect funds, they utilize SwiftNet by beneficiary is notified when the depending on the need of the money transfer. And then there are local banks, regulators, and there is sender ID, beneficiary ID, so on, so forth. And what is the current state pain points? Inefficient onboarding, vulnerable KYC, cost and delay, error prone, liquidity requirement, vulnerable KYC, similar to 2, but then this is basically in terms of maturity levels, and then demanding regulatory compliance. See, we have seen in the first earlier module on introduction of use cases. Then we went into the second level where we have seen how do you actually summarize this, and now we are going deep dive on each of the use cases, at least the critical ones in the financial industry. So this is a three tier mechanism that I've used so that you guys can actually understand a bit of how this entire thing can be used, and you can develop your own use case based on the experience that I bring in this presentation. And this is a future. You have trust between the sender and the money transfer just through smart contracts. Currency conversion is easy, and it's real time. Just verification of KYC is online, same ledger, and it's also agreed with regulator, and transaction history is available and can be continuously reviewed by regulators. So these are some of the advantages of future state prediction. The process is same, but then you cut across the intermediaries. You had so many of supporting actors in this slide. If you go back, you see these actors here, but here it's all like straight. Benefits is like seamless KYC, liquidity issues can be solved, real-time anti-money laundering, reduced settlement time, cost savings, and automated compliance. So this whole lot of payments future state. So we need to understand the benefits of this. So how blockchain can or distributed ledger technology can actually outweigh the whole current process and trends. But there are some critical conditions. You should be via standard KYC process, ensuring compliance and legality of cryptographic hash to exchange value. We need to understand that, and you need to adopt standards. But whatever it is, the critical conditions categories are alignment of stakeholders, technology, regulatory, and governance. So these four are the ones. And there are some challenges of every process that, but then we can overcome that. Be it a legal precedent or prioritization, levels of urgency or policies. But then the critical conditions can be mapped. There can be additional considerations like embedded solutions, cryptocurrency linkage. Again, it's a debatable point. But then these are some additional considerations that we can do with global payments. And solutions can be like, they can be in the core banking integration. And if any bank wants to actually subscribe at a later point, then that also actually should be service levels with the leading banks. So we've kind of completed this first use case in terms of how global payments can be actually done with considerations. That's a very important aspect.
That's all for this session. Next, we'll discuss about use case P&C Insurance, property and casualty insurance in blockchain. Thank you. Hello, in this session, we will discuss about use case property and casualty insurance.
So similar way we will understand how PNC claims processing happens. Current state, if you understand, insurance is a financial risk management, and it has many of the categorization. It comes from like commercial property, casualty, perfect business, in terms of loss and this thing property. So basically it comes with a lot of caveats and if claim kind of if then statements. But if you see, property and casualty is the second largest insurance in the world after life and health, and claims processing is a key bottleneck. So we see that you have a whole key ecosystem stakeholders, insurer, reinsurer, regulator, and let's see, DLT has the potential to actually optimize the back office operation cost whole sum, you know, and this use case has been like very good. And you can see the market participants, insurer, insuree, regulator, broker, supporting data source. So you have diversified data sources. You have like uh, regulator who is like determining whether it's going on a right way or not, and you have insurer, insuree, reinsurer, so on and so forth. This is a current state. It's a 8-step process. You have first step as claim submission. In that you have 4 sub process. You have loss assessment. You have again 4 5 sub process, and you have finally claim approval, which is 2-step sub process. So once the claim is submitted, it goes for an approval. It identifies assessment of loss. If they require additional information, they go for it. Then they get claims approved. Then claims agent actually initiates payment. But let's see what are the current challenges in this. The pain points is like undesirable customer experience, costly intermediaries, fragmented data sources, fraud, manual claim processing. This actually leads to duplication. We don't even know which is a valid coverage. So customer experience is like pretty bad, and you might not know how this entire thing can weigh out. So basically, you just need to be gung ho of the fact that there are a lot of pain points. Not that the system is not foolproof. Current system is running, but then every time you come into technology, it actually disrupts. So that's the beauty of even distributed ledger technology and even blockchain. So this is the future state: claim submission, loss assessment, claim approval, all in the same page, and it all done by smart assets, automated claim approval applications, claim diligence is through smart contracts. DLT, because you automate, there is no secondary data sources, right? So you can have, if required, and a smart contract can actually automate the liability. And claim is approved, the payment is done through a smart contract. So it's a seamless support. It's a similar ledger. Approval processes like faster, seamless transfer of money, and coverage is very extensible, and it's immutable. So what is the state benefits? It's simplified automated claim submission, enhanced customer experience. I just want to throw that, it's a seamless transfer of loss information from insurer to insurer, that it eliminates the need for brokers. Again, automated claim processing, so you just need to not review everything, but loss adjusters will be very fast. So the smart contract actually eliminates the need for loss adjusters, and reduction in fraudulent claims, because you have a class of asset and provenance, enabling better identification of the suspicious behavior. It integrated with the data sources, and it has streamlined payment processes. So you see, like, most of them is like very, very properly aligned. And that's the reason you can see, like, the benefits are much. But there are critical conditions. Building a comprehensive set of asset profiles and history, challenging. Adopting standards for claims data, challenging. And providing a regular regulatory framework, is again challenging. But what's the challenge between the first one is comprehensive set of asset, because it's emerging in the markets, so convincing the whole ecosystem will be a require stakeholder diligence. In terms of adopting standards, there are a lot of company specific processes, and extensive discussion will have to go on in this entire thing. And finally, providing a legal framework, just started coming out, and then we will see that, it should not jeopardize the interest of some people, so especially the government and other stuff. So that's kind of critical condition that we need to understand. So conclusion is like, the outlook is good. There's an opportunity maximization in terms of DLT with finance, especially insurance. Why? Because it's creating immutable insurance claim records, development of asset provenance, and P2P, that is peer-to-peer insurance. So you have a peer-to-peer DLT products that's coming out. The key takeaways here is like smart contracts will be key, and loss adjustment expenses may become irrelevant. And so, but the two conclusion that you can do is, it automates claim, and it reduces fraud. But still, there are unanswered questions: profitability and pricing. Will it change in terms of overall ecosystem? But seems to be very positive. Profiling is good, and it's kind of disrupting. There are some unanswered questions which we have to conclude over time in terms of how you actually accentuate the claims processing, but property and claims after health and life is the biggest use case in business today in financial industry.
That's all. We will cover use cases in syndicated loans in the next session. Welcome to this session. Now we will talk about use case in syndicated loans in this session. Let's start then.
So we have seen the earlier section in terms of trade finance and payments. Now let's understand how syndicate loans are like, based on the framework that I have created for loans. So in this we will try to understand the assumptions, scenarios, ecosystem, conclusions, how it's beneficial, and so on and so forth. So what is syndicated loans? Basically, syndicated loans provide large scale finance diversification, and this is for a large investor. It doesn't like one investor serves as the lead arranger, and it's actually done through loan life cycle, charging on a fee based on the complexity. So you have most of the Europe and US markets is like dominated by incumbents, and the Asia Pacific market is growing, and Latin American market is like immature. But what is the potential here is like, you have a lead arranger, it's been with the regulator, requesting entity, and a syndicate. So the complexity is very huge, and DLT has a potential to even optimize the backend operations. And it highlights the key opportunities to end-to-end syndicate loan process. Let's understand a bit about how to go deep dive into this. So who are the core guys? You have a lead arranger, you have a syndicate, basically a group of investors. Requesting entity, it can be a large loan, it's a large organization. Like for example, if you have to top 500 Fortune companies, or mid-tier companies, more greater than 5 billion in turnover annually. So what's the current state process? It's a 6-step process, and large corporation requests a loan from a financial institution. Basically, it's a lead arranger, and the second procedure, he performs the KYC, and it actually also, to reduce risk, he arranges sources from funds from other investors as well. and they facilitate, the lead actually facilitate to understand how to determine the corporate financial health, and it can be like risk. Then syndicate members pledge a percentage of the overall risk with tolerance level, and basically last is like earlier and you take them administrative. So basically till the disbursement, from the time corporation requests a loan till the time disbursement, and it is like syndication, diligence, underwriting, and closing and servicing. So you have a kind of 4 steps, and there are 6 sub steps into it. So what are the main pain points? Yeah, the business workflow. What is the pain points? It is time intensive process and review. Technology integration is actually lacking. It's labor intensive. Even underwriting systems do not communicate with the core systems. Inefficient fund dispersal, default risks, delayed settlement time, costly intermediaries, siloed systems. So there are a lot of pain points that goes with the governance on syndicated loans. These are high level, and actually this has to be disrupted, in the way, not that, the current system is not functioning, but a technology can actually completely disrupt and then give a new way of, process. And that's where your blockchain comes in, distributed ledger technology. So future state is like, you have all of them in the smart contract, all of them pledged with similar ledger, and the process is actually almost similar, but it is like accessible data through the distributed ledger technology. Risk management comes down to a great extent, and it's a seamless KYC process. And finally, like, it reduces the overall underwriting, because it's like some of the intermediaries is not at all required here. The process is same, but it automates. Selection is automatic. Transfer of the data is between smart contracts. Diligent process templates available in one ledger, and it's like, if you have to take Hyperledger, the actors, so how the syndication process happens, and then we can agree, disagree, and then approve consensus within the same ledger. So it's like a pretty easy process. Of course, implementation will take time, but at least it's all in the same ledger. There's no disparity, there are no siloed systems, approvals are faster, technology integration is easy, so on and so forth. So benefits, I've already combined, automated syndicate information through smart contracts, embedded regulator, it's basically like AML KYC has become a part of the process. Automated diligence underwriting, technology integration, reduced closing time, so you don't need the T+1, T+2. Servicing intermediation, so disintermediation, you completely eliminate third-party intermediaries. Reduce counterparty risks, whether it's principal, interest, whole life cycle of syndicate loan is automated. So completely reducing operational risk. So hope you understand this process. We just define what is a use case, what are the current process pain points, then how we are using, how the entire process is transformed using DLT, and then what are the benefits. So this is a framework I've been using for all the use cases. So there are some critical conditions. Again, building risk rating framework is little risky. Standardizing diligence and underwriting templates, and providing access to financial details on distributed ledger. Yeah. What are the challenges? Let's understand each one. You should have a single standard of counterparty rating, which requires an enormous amount of coordination and governance. So it's a challenge. The myriad diligence is like, underwriting collection vehicles across financial institutions will make one alignment around one format difficulty. So that's again a standardizing digitalized diligence underwriting templates. And finally, providing access to details on the distributed ledger, whether it's liability model or mitigating the risk, all are in same thing, right? All the participation is same. Basically, again, critical condition categories are stakeholders, technology, regulatory, and governance. So that's a whole charge about it. This was discussed in World Economic Forum as well in 2016. So what is the conclusion? Takeaways is that it's loan lifecycle management via smart contracts, executing servicing in disintermediation. That means that they're completely throwing away the intermediaries to the smart contracts, eliminating the third party fees. Outlook seems to be good because it has smart contract settlement and servicing, automated underwriting, and account servicing via smart contract. The summary is, you have an underwriting automation, regulatory transparency, and cost savings. All three put together. And some of the unanswered question is, implication of KYC more public, Yes, there are issues. Let's see how over the maturity curve it will kind of change over, But overall summary looks good. There's a huge amount of cost savings because the process of execution and settlement sub process is completely knocked down. And second thing, intermediaries is like, eliminated and third party fees is completely away from the process.
Here is the end of the session. In the next session, we'll get an idea about use cases of trade finance. Thank you. Hello and welcome to this session. As we have discussed before, we will understand use cases of trade finance in this particular session. Let's jump to the session then.
Where we are trying to understand the trade finance on the same framework to some detail, and it's basically on deposits and lending, which is like trade finance. Again, trade finance we have understood in some of the modules. So you have a lot of actors. It has importer, import bank, exporter, export bank, inspection company, customs, freights. So basically, where is the DLT is like potential to optimize the regulatory and operational cost of trade finance. And this use cases actually highlights the key opportunities in end-to-end trade finance process. So you have piecemeal concept, you have prepayment, you have counterparty performance. So everything is like current state, and financing is actually dominates world trade, because you're going to trade $18 trillion. That's a transaction, and finance is the main one. So market participants, you see so many guys which are core. There's inspection company, freight, customs, correspondent banks. All are supporting actors, and they just defined what they do. So what is the state process? It has established payment, deliver goods and settle on terms. That means buyer starts ordering, it goes through a letter of credit from the import bank, it reaches the shipment and it's verified, or either way, it's basically an importer or exporter, sale of terms or sale of products at a future time, and there all the customs verification happens, and then the goods are received either through a seller to buyer or buyer to seller, and then payment is initiated. So this is the current state process, almost like a 10-step process. 10 sub-step process, and then at least three top tier processes. So what are the pain points? Manual contract creation, that means huge documentation. Invoice factoring, basically we don't know whether it's a short-term invoicing or long-term invoicing, because it depends on the delivery of goods. Delayed timeline, because the shipment of goods due to multiple checks and balances by intermediaries and numerous communication points. Manual AML review, because the export bank or the import bank does manual anti-money laundering, multiple platforms. This is a very, very problematic issue. You have one company with one ERP, you have other company with some core banking software, and so on and so forth. So fraud is very high. Duplicate bills of lading, so you don't even know some of the bills have authenticity. Multiple versions of truth. That means like one entity to another entity in terms of financials. And delayed payment. Disbursement of funds, God knows, like sometimes from the export bank or import bank, how long it takes. So future state, simple, all through smart contracts, goes as a letter of credit as a smart contract, digitally signed. Customs origin through digital signatures, inspection through local, through IoT based blockchain, and acknowledges goods, which again import bank via smart contract. So this entire process is seamless, and they are going to sit on a simple blockchain platform or a distributed ledger technology, So you have real-time tracking of shipment, you have real-time tracking of finance, you have real-time tracking of invoices, whatnot. And payments and settlements actually is fast. So it will be advantageous to the bank which finances for the buyer or seller, right? Both ways. So what are the benefits? I said like real-time review, transparent factoring, because invoices are real-time. Disintermediation, completely eliminating the correspondent banks. Reduce counterparty risk, bill of lading, we don't even know the authenticity. But here it is easy. Decentralized contract execution. Whoever is the actor in the entire ecosystem, there is a decentralized contract execution. Proof of ownership. There's a complete transparency. Automated settlement and reduced transaction fees. I did discuss on this. It completely needs to eliminate the correspondent banks and reduces fraud and increases transparency. And AML KYC processes kind of understood faster. So you see this, the whole chain. But there are again the conditions. The conditions are based on 4 categories: stakeholder alignment, technology, regulatory and governance. But in terms of trade finance, transparency into trade finance agreements, that is first. Then you have enabling interoperability with legacy platform, because there's so many legacy challenges, and rewriting regulatory frameworks and legal, So what are the challenges? Like, the shipment, everything should be governed, and there should be transparent sharing of financial information. And then interoperability, there are multiple solutions, so you should have freights, customs, shipping agencies, exporters. So you should be able to capable of interfacing with any blockchain ledger. And then you also have a legal presidency, that should be easy to assess by maybe use of smart contract reporting, but little difficult to establish, because of multi-party systems. So again, these are some of the critical conditions, but then there is process is becoming so transparent that this is getting matured. So what is the conclusion? That means like the application of DLT exists within trade finance. So the letter of credit is encapsulated in the smart contract. There is an electronic invoice ledger, and opportunities exist for financial institution to reduce the counterparty risk and fraud by reducing the invoice factoring and reducing bill of lading. At least who are the authenticated guys. The key takeaways is like managing the whole ecosystem using smart contracts. It can capture anything, and DLT utilization is actually disrupting the role of correspondent banks, as financial institutions can work directly with another. The summary is letter of credit automation, regulatory transparency, new product opportunities. Of course, this has been there for everything, but then for even incumbents, and cost savings. I don't know, at least we can save up to 30 to 35% of the cost. Then what is the impact on financing fees? We need to understand what is the level of disruption, and how does it fit to the existing trademark, with this process, current state process, how does it fit? So it's very important. So overall looks good, and we have understood bit of that trade finance as well.
That's all of this session. Hope you get a clear overview about the use cases discussed so far. Next, we will discuss about CoCo Bonds, and it will be very interesting. Then see you in the next session. Thank you. Welcome to this session. As we have discussed before, we will know about CoCo Bonds. So let's jump to the session.
So let's understand the contingent convertible CoCo Bonds. So contingent CoCo Bonds, basically it's like a capital for any company, with an investor. And basically banks are responsible for calculating the capital ratio. And some of the places like CoCo Bonds has been flat and light, but still it is one of the extreme volatile instruments, But DLT has a potential, that is distributed ledger technology has a potential to embed regulation into business processes, and it reduces volatility and uncertainty. So basically CoCo Bonds is like a capital ratio that every kind of banks need to protect themselves as bonds. So you have not many things, but the reason why is like it stabilizes and it provides authenticity. These are some of the market participants. And current state process, banks determines what is the ratio. It should be like should be falling to 7.5%. Then they have a conversion of CoCo Bond to equity. So there is a maturity curve, basically monitoring. One is issuance, the second process is monitoring, and then loan absorption. So you have all the three processes, and it's a sub-step process. Like it's not very big, but the volume is huge. Understand the 7.5% below capital of a large bank is important, right? So that's why your CoCo Bond is important. And the pain points is limited participation, inconsistent trigger, ambiguity because there is no stress point of how much needs to be absorbed by a bank. Real-time reporting is further reduced. Market fear because volatility is very high, and delayed activation time. Sometimes since it's not regulated much, maybe converted. Sometimes it's like even before the condition is met, they convert the bonds. So future state, it's similar to current state, but then they use the record keeping functionality of distributed ledger. That's where I've explained the record keeping, asset management using record keeping, right? I'm given an example in the other module, so it's very important. Then it's like a tokenization, right? So you have some trigger that there is a tokenized asset against the bond and converted in a predetermined conversion rate, rather than just unexpected rate. You can also decide, because all of them are in a maturity curve within the ledger, so it's easy. So what is the future state benefits? You have increased participations, you have improved calculations because kind of capital inflow in the distributed ledger technology, real-time reporting, reduced stress assets, and real-time activation. So all happens on a real time. But again, I have given you a kind of critical conditions, standardizing attributes. Then that's the first condition. Streamlining trigger calculations and developing process. So all three sits on the same thing. Stakeholder element, technology, regulatory, and governance. So challenge has been different. So for first challenge, each market requires different data. So not standardized across FIs, that is financial institutions. There are trigger values independently and dependent, and there's some degrees of automation that is required, and deploying processes because may significantly overhaul since they are additionally required to point access stress test. So you have a layer of why, you have a layer of what they are doing, and what are the challenges. But then it's one of the use case that it's already gone in live. So conclusion is that outlook is good, while benefits is basically the process execution because you are using the records keeping process of DLT. So why? Because it improves monitoring and increase investor confidence and empowered investors and allows point in time stress tests to become irrelevant. But then there are business drivers that needs to be identified and to overcome this entire contingent convertible CoCo bonds. Overall looks good. The main reason it's been the benefits are process execution.
Hope you will get a clear idea about the CoCo bonds after completing this session. See you in the next session where we will be discussing about the investment management compliance. Thank you. Welcome to another session of this module, which is all about investment management compliance. Let's get started.
So what is automated compliance? So you have a lot of compliance, right? Can be like audit, tax, fees, security exchange, filing, so on and so forth. You have key system holders. So what are the things? Compliance costs are high and auditing costs are very high. This use case actually gives you an opportunity area for distributed ledger technology in the financial system audit process to highlight the automated compliance solution. Let's understand how it helps. So you have the whole market participants, you have auditor, you have financial institution, regulator, accountant, Federal Reserve, and Internal Service Review. So basically, these are some of the actors, these are the use cases, and we had a technology embedment into this whole use case. So the key thing is you need to identify the business process in the initial stages as a use case, and we have to apply distributed ledger technology, how it brings in benefit. So similarly, the current state process, you have auditors work with the bank, the audit team performs risk assessment, there is multiple copies, the auditors evaluate the information, and they work with the leadership team. Any errors, then exceptions are identified, and the report is formed, and then bank uses the report to populate its quarterly and annual filings. So again, it's planning, assessment, follow up, and reporting. So there are 4 steps, and then there are 7, 8 sub steps. It's a simple thing, right? Any organization should go in terms of compliance reporting. The pain points: resource intensive, time intensive, lack of technology integration, resource intensive. Again, when you have to do audit reports, they're directly not fed into the quarterly reports, right, of the SEC. So it's a simple, complex pain points. So future state, all financial auditing thing can be done through DLT, through data extraction. And then there is a representative. So if you use Hyperledger kind of a thing, they can actually get onto the distribution, data distribution. A smart contract facilitates movement of financial reporting instruments like BE. And finally, DLT is actually distributed ledger is seamless executing automatic compliance such as comprehensive capital assessment, enterprise tax filing, real-time tasks for trading financial instruments, and processing information about regulatory things. So the process is same, but then automation is kicked off, data extraction is easy, audit report is transparent, and then seamless execution or automation of the compliance activities. So what is going to be the future state benefits? Data transparency, that's one. Automated review, reduce errors, integrated systems, and financial access real time. So multiple layers of this data gets knocked off. Automated review because just through software, and reduce errors because resource intensiveness comes down. And integrated systems, you don't have multi-party systems or siloed systems. All this happens here. Finally, authorize real time, because who are the guys who are kind of acting in this. Again, critical conditions, you provide compartmentalized access to data, you have automated, faster, and efficient enforcement of regulations, and enabling interoperability. So these are some of the conditions which you have to understand. There are some challenges. First challenge is for providing compartmentalized access to data. You should have access to whole, not provide the capability to partition. Like currently, you may have some auditors getting in, some auditors not getting in. Again, that's a challenge. And automatic, faster, regulations. So you should have a faster process and transparency between the financial institutions and the regulator. And finally, interoperability, because legacy platform, that's always like a known fact with any of the technology use case. And finally, conclusion is there is a continuous audit process. The outlook seems good. There is an AML KYC verification and automated tax filing. Opportunities like eliminate planning and automated assessment reports. So, what is the summary? It has process automation, it increases regulatory transparency, and it has cost savings. What is the continuous takeaways? It audit continuously and it extracts financial data. So overall, automated compliance is a good one. And still, there is a unanswered question: is like how frequently the financial audits can be done, because it can actually backfire the investor decisions, right? How frequently we have to do it is real time. So when do we have to report all the data, and then how often, how do we file? These are the process that needs to be identified. But then, yeah, there can be, this technology has just started, so we will come maturity curve in this also. But this is one of the largest use case, compliance, because be it any financial institution has to comply to this.
That's all for this session. We will cover investment management, proxy voting in the next session. Thank you. Welcome to another session of investment management. In this session, we will discuss about investment management, proxy voting.
Then proxy voting, that's one of the investment management thing. So what is proxy voting? Because it's basically very simple. You have investors. If it's a general body meeting, they have a paper format of submission for the decisions, or they send through emails and so on and so forth. But then this is a potential to use transfer value, and this basically highlights the key opportunities to improve retail investor participation. Again, there are participants here: corporation, investor, third party, and regulator. This is again distributor proxy statements, review proxy statement, cast vote. A 3-step process, but then if it has around 7 steps, sub steps. But then it's very simple. If there is any change in the management, or if there is a financial decision that has to be taken with the independent auditors or the core team, so this entire thing has to be approved by the retail investors. So this is a process which current state it is. They send it through email, they send it through online, they send through paper, so on and so forth. So there are many pain points, ambiguity, costly distribution process, limited distribution. Some of them don't receive the communication because the address would have changed or the emails would have bounced. Misleading representation. Sometimes we don't even know who is kind of answering them. Error prone, manual intensive, minimal retail investor. That's one of the key. Lack of transparency and voting discrepancies. You may even see fudging, for somebody voting for somebody else. So all these are issues. Again, future state, similar, a smart contract can run on that. Orders are executed through DLT, and investment records are like, including the number of shares, are actually lying on the investment distributed ledger technology. And then there is a smart contract sent to all investors, and then the investors assess the potential of value. They either vote through DLT, through a tokenized asset, and the smart contract validates these, and then results are shared. Very simple. Just that it brings in value. What are the benefits? The intermediaries are cut, streamlined distribution process, improved accessibility and participation, and automated analysis. Validation is automated, increased transparency, and improved accessibility and participation. You can even do it with native mobile, and then that too on distributed technology. That's how it's been termed around. So again, there are some critical conditions. Storing investment records on distributed ledger, very critical assessment assumption. Integrating legacy voting, and collaborating across actors. So challenges are many for each one of the conditions. Storing investment records, because again you need to validate the digital identities. It should not have anonymity. And immediately on the even the legacy voting, so how do you actually integrate the process which is existing now? And finally, across actors, challenge, through smart contracts. The conclusion is good. The outlook is like basically explored by Nasdaq, and financial institutions has improved to use this use case. But the summary is, it has a streamlined distribution and automated reconciliation, and it ensures voting transparency and central authority discrimination. is kind of removed. But then what is the cost versus benefit? This has to be understood. So overall, this is again a good use case for financial institutions for quoting.
This session ends here. Next, we will know about asset rehypothecation. Thank you. Hello. As we discussed before, we will cover asset rehypothecation in this particular session. Let's get started.
And asset rehypothecation, this is one of the use case. So basically, asset hypothecation is a practice which ensures that any organization actually pledges their assets, and the secondary market is large, and basically the process is like you need to come out with the end broker or end dealer process. That's where you are. So you have a broker selling, buying, regulator. Again, you have a asset rehypothecation. It's a simple process, right? For us, you can have two counterparties, you have 3 counterparties, you have 4 counterparties or 5 counterparties. So depending on the asset, how much you want to pledge, and then how much cash you want to generate based on the assets, you can actually identify the ownership, and it's a little clumsy process. But the customer possessions the home. The pain points: lack of regulatory reporting, counterparty risks, lack of transparency, security value, high ambiguity, and systematic failure. The future process can be all seamless because it can be transaction history on distributed ledger technology, a smart contract which can encapsulate the entire thing. It broadcasts between the information ecosystem. Then as a fourth, they receive the history, and then regulators have a real-time access to view the transaction details, and the smart contract readily hypothecation of asset can be like rehypothecation rules and things like that are simplified. Benefit: transparency, counterparty risk, automated processing, embedded risk regulation, automated enforcement, financial stability, and disintermediation. Some of them are very common across use cases, right? And then some of the critical conditions: they are using a tokenized assets, using a standard. That's one of the condition. Fostering engagement among the financial system, again that's condition. Architecting solutions to maintain the templates. So the challenge has to be like how tokenized standard can be difficult to establish, and who are the people, and engagement with fostering with the whole ecosystem, right? Again, participation. And finally, architecting solutions. So you have to have a technology provider that can flexibly provide flexibility and minimal downstream. So again, these are same thing: stakeholder, technology, regulatory, and compliance, just hypothecated to asset hypothecation. And finally, conclusion: this can be used for gold markets, repurchase markets, asset transfer. The opportunity is basically on the counterparty risking systems, asset transaction history, regulatory transparency, and but summary is like there is asset tokenization can be good, important. It's already started. Regulatory compliance, which is cut across all the use cases. Collaboration, because you have a significant amount of collaboration and standardization, but it reduces counterparty risks and it brings in financial stability. So these are some of the key takeaways. But how do you identify an asset with a history? Value is still unanswered, and how regulators will assume to comply with this implementation. So these are some of the asset rehypothecation. So there are critical conditions here: benefits, state process. But then the current state process is not very process oriented, but then it is like more of a participation here.
Here is the end of the session. In the next session, we will understand about equity post trade. Thank you. Welcome to another session of this module. In this session, we'll discuss about equity post trade. Let's jump to the session and know more about it.
And last one, this is again equity post trade, which we know is another use case. So you have, these are the market participants, and these are core, and who are the supporters. This is the trade process. You have trade execution, clearing, settlement, and asset. So everybody is aware of this, right? I'm doing an equity trade. I basically sell, buy, and there's a clearing corporation, there's a settlement corporation, then there is a asset servicing also in terms of large corporates, who just acts as a brokers. So again, there are a lot of pain points. Duration between trade execution, that means like it takes T+3 days for either sell. Once you sell, it gets 3+3 days to settlement. Inconsistent data, this is a little counterparty risks. operational risks, settlement ambiguity, complex account keeping, and cost intermediaries. So again, these are some of the common philosophical pain points in this also. And future is like very simple. They will place the equity orders through an exchange, and the exchange confirms trades and processes. There is a smart contract that generates between banks, and once the smart contracts transaction happens, it ensures some simultaneous transfer, and then confirmation is stored on the distributed ledger technology, and assets are also in safekeeping accounts, right? Because a key resource management for asset management is blockchain. That's where, and servicing level agreements can be easily done. So benefits: reduce settlement time. It can be real time because this T+3 also reduce standardized data requirements because there is a process, be it settlement, clearing, everything is standardized. Reduce counterparty risk because it's easy to operationalize. Real time confirmation, reduce account complexity, and it reduces the third party need. So again, some of them are common, but identify the thing is like settlement time is a key. So challenges: how do you incorporate transaction benefits with settlement, achieving multiple stakeholder alignment with participants, and standardizing reference data, with market rate. So let's understand what are the challenges. Smart contract executes in real time, but there are some trades which are batch trades and which may require frequency at a normal time. So that's one of the challenge. Then clearing and settlement process. How do you have a liability model, in case of technology failure? And third thing is utilization of reference data. Significant collaboration is required to standardize attributes that are not prone to constant updates. So the custodian banks need to work together to develop a standard set of data fields which matches the investor anonymity and confidence automation. So that's one of the key in this critical condition. But there are some good takeaways because it's real time. It embraces the technology confidence for investors and so on and so forth. So non-finance, you have seen a lot of non-finance, just like in IoT and other platforms, just for information. So with that, we complete the use cases in complete understanding of 9 subsections in the deep dive of the use cases.
That's all. We will cover inclusive finance in the next session. Thank you. Hello. As we discussed before, we will cover inclusive finance in this particular session. Let's get started.
So we have seen a deep dive of so many use cases in the earlier section. Let's study a bit of inclusive finance, just a run through of these case studies in this section. So there's a lot of financial institutions. So there's still unbanked people, 2.5 billion. There are a lot of availability by birth certificate, passport, etc., etc. 1 billion have cell phones, but then these are digital, specifically mobile financial services. But then digital inclusion is a key. So digital inclusion is a prerequisite for financial inclusion. So we are having countries like Estonia going for digital residency, and some of the other ones is e-voting on Tallinn Stock Exchange. So I'm just running through some of the current examples in this, nothing more than that. So there are some of the things like collaboration between Consensus, Microsoft are creating an open source blockchain based identity system, again in very, very important for banks and financial organizations. It's called IT 2020, and there's another project like ID 2020 conference, which is kind of identity crosses. And basically the reason is that it's a UN sponsored, and basically they want to show that everybody should be accessing the franchisee of their identity. That's the most crucial one. Basically the reason is like it's a web based or a wallet based identity management system. All data on the blockchain is public, but then there will be a determined by private keys using a blockchain standard ID. So it's a decentralized identity for all. It's called UPort. So it's going to solve the identity crisis. So Dingle digital key, it's a big proof of concept by Deloitte. So again, they are digitizing the traditional identity concept. So basically, this is important because if you need to bank, you need to know who are the digital identity, and this can solve these cross-border platform transactions, passport problems, all and so on and so forth. Again, Deloitte, they are actually componentizing the blockchain to a proof of concept stage. So basically, blockchain records in real time. So this needs a ledger of everything, be it marriage certificates, marriage licenses, education degrees, financial accounts, insurance claims, votes, provenance of food, anything that can be expressed in code. So basically, blockchain is a ledger of everything. It's a new digital ledger of economic transaction that can be programmed to record almost any of the thing of a value. So micro insurance agreements can be converted to smart contracts. How very well used to solve simplicity, easy to underwrite and adjust, and small premiums and high volume transactions. So you have seen a blockchain insurance policy, a micro insurance policy with the software code in the software smart contract. So we have seen that. What are the advantages in inclusive finance? It innovates products and growth, increase effectiveness in fraud detection and pricing, reduce administrative costs. Scalability is always there. That's a disadvantage. Security, standardization. Of course, any technology implementation will go through. Okay, and I just want to iterate that BFSI stands for Banking Financial Services. So other potential implications like automotive, financial service requirement, voting, healthcare, all are coming up. And that's it. So it's basically on inclusions and some of how it is can be increasingly effective in the current generation.
This is all about this module. We will conclude this module here. Hope you have understanding of the use cases in financial services. See you in the next module with next generation blockchain technologies, where we will cover Skyledger, distributed blocks, billion group, etc. Thank you.